Hi, I'm Mike Caldwell. I'm the Director of the Business Innovation Zone. The Business Innovation Zone, or the BIZ, was created to help high-growth potential entrepreneurs and businesses in central Iowa. We provide a variety of services, including mentoring, consulting, counseling, validating business models, and help with access to funding for high-growth companies. We offer also a number of networking opportunities, including luncheons once a month and all-day seminars on subjects such as marketing and finance. You can find out more about the BIZ at www.bizci.org.
Thanks, Mike, for the introduction. Excited to be here. Excited to talk about the outlook for raising equity capital in 2011 and 2012. A little background on me. I'll start with background on me and the firm. A little bit about what we do for those that don't know me, and then talk more directly about the equity markets. Okay, Equity Dynamics, also called Papa John Capital Resources, started in 1969 by John. John still lives here in Des Moines. He's 82 years old. He's been at this 42 years. Think of it, I was 2 years old when he started Equity Dynamics. You know, that puts it in perspective. He's been around a long time and has a lot of experience. Most of what we do, 60% roughly of what we do is healthcare related. We invest only in the United States. We have looked at a couple Chinese deals, but we haven't pulled the trigger on that yet. It's a private fund. It's basically John and his money, his wife's money, his daughter. He has a couple happy limited partners, which are his family. I invest my own scratch as well. I've worked with John for 15 years, something like 40, I lose track, 40-some companies that we've invested in. Of course, looked at literally thousands of deals that we've not invested in. I've served as a president and on the board of a public company, and of course a lot of private company boards. What do we do as venture capitalists? We focus on building equity value. That's really what we do every day. We invest. We only work with companies where we're an investor, right? Where we put capital in. We don't have any consulting services. I mean, I try to help local entrepreneurs, but we only do it if we have a stake, generally. Quick summary, I always say it's all about building a bigger pie, creating a bigger pie. Example here, a founder owns 75% with some angels and some employees with options. We put in some capital. The whole idea is, can capital help grow a business? Sometimes it can't, and I'm all for, matter of fact, I'm involved in one, a business that can grow without capital. It can get to cash flow positive so early and then reinvest that cash. Hey, if you can build that kind of business, it's great. You don't need people like me. You don't need us. And take an e-dilution, you own 100% of it. The question is, can you, sometimes it applies, can you take a company that maybe can become a great lifestyle business, 10 million of revenue, a lot of profit, can you take it to 100 million of revenue? Clearly, a company worth 100 million of revenue, with 100 million of revenue, should be more valuable, assuming the other metrics work. But that's what it's about. Can you, are there different things that capital can do, plus some of the other intangibles that we or another firm could bring to the table to help grow a company much quicker and make it more valuable? A couple things we're not. We're not job focused. We're not economic development. We always say, keep your A players, and there's no room for B and C players in small companies. If you have average people in a small company, usually the answer is get rid of them. Because you have to have a few very dedicated people, and it's important to build the culture of a company, of excellence, and to exceed. If you have average people, you're going to end up with an average company. Generally, what do? This is what we try to do. We try to help build great companies. We start there first. Build a great company, then, whether we'll get paid for it, whether you sell your interest or the company goes public, you'll get paid for it at the right time. Getting liquid on it is separate than building a great company. Focus on building a great company and do the right thing just to do that. What's that primarily? The number one item is team. And a lot of what I do is, work on the team members. We hire generally the top 3 or 4, and we're involved in hiring the top 3 or 4 of all of our companies. And of course, one thing I'll say about our firm, we're very active. We're on the board of every company we invest in. There's only a couple small exceptions, maybe where we're on the board the first 5 years of life and then we moved off the board. But we're very involved in our companies. That's the nature of our firm. We're very active. So we're involved in hiring team members, CEO, COO, CFO, Chief Marketing Officer, different roles. Industry contacts, especially, for instance, in healthcare. 60% of our business, we're very tied into healthcare. All kinds of different businesses in healthcare. John, being around 40-some years and being blessed, as he says, blessed with a very recognizable name. Most people think he owns the pizza company, right? Matter of fact, people will call our office and leave orders on our message at lunchtime. So, if Papa John's Pizza, I'm surprised they're still in business here in Des Moines. They're probably getting a bad rap for not being responsive, because we don't worry about those calls. Industry contacts, so you can imagine, I think of how many contacts I have being in this business 15 years. John, having been in the business 40-some years, a lot of contacts. Business model, clearly we see a lot of business models. Some work great, some don't work. I think we have a pretty good sense. Depending on the business, we can help in that regard. Deal expertise. If one thinks about how many deals, a CEO or a CFO, how many times they sell a company. We work with one CEO. He's CEO of a public company the third time for us. So he's had 3 recycles where he started early on in the company, became the CEO, ran it as a public company, sold it, started another company, public company, CEO sold it, and the third one. He came to us and said, let's find a business together. We bought a business in Maryland when it was $8 million in revenue and $65 million in revenue. Sit now, after about 3 years. So, great, probably our best CEO, but my point is, that guy's very unusual. He's done 3, 4 deals in his background. We do, in our office, between John and myself, I don't know how many M&A transactions per year, but it's a lot. I see a lot more deals than a CFO of one of our portfolio companies may see one every 4 years. I see one every 3 months, or more than that. So we help there if we can. We invest our own scratch, but we also are pretty good at helping raise capital for companies. A lot of contacts on Wall Street, a lot of contacts with investment bankers, a lot of contacts directly with investors. We raised $9.1 million for a company, or helped one of our companies. John didn't invest any of this $9.1 million, but our contacts, John's direct contacts raised about $4 million of it, just friends that wrote $1 million check like the business, but the rest of it was banker contacts that we had to help raise the money. Now the company saw us pitch a story. We help pitch a story, we open the doors, but if it's not a worthy company, if it's not a good company, it's impossible to raise money. Business experience, the nature of being around the block so long. We target to become an industry leader. Our best returns, our big hits, are when we invest fairly early in a company that ends up leading its niche industry. We had a HIV drug distribution company. Pretty low margin business, actually, but they wrapped a whole disease management solution around it and grew it from roughly $2 million in revenue. We actually bought it out of bankruptcy, $2 million in revenue up to about $300 million in revenue. That kind of business, and it was a leader in that area. Ultimately, when we went to sell it, we had a couple groups that wanted that franchise. Industry leaders get paid more, they're higher multiples, basically. You get paid more for those, so that's what we target. What else do? We try to help great companies reach an exit. If we're involved, or any company actually, if we have a tough deal, we are helpful at trying to reach an exit for the other shareholders. Again, the investment banking contacts, other industry contacts, positioning and timing. We've been around, and I'll go through some slides on the overall market that'll give you a little more background on positioning and timing, but how to position the company, try to stay up with all the different research, especially the big buyers in the sector, and what are they, we read a lot of research, try to figure out what they're doing, where they're going, how do we fit into that? When's the right time to approach them? Because sometimes if they're going to spend $20 million and build it, if they've already spent $20 million, it's a little late to go to them for an acquisition, or potentially too late. Buy and sell expertise, working with the lawyers and really the negotiation on the deal side. We're involved in a lot of those negotiations. That's part of what we do because we have so much experience at it. Outlook, now to the main presentation here. Outlook for 2011 and 12. I think of the equity markets, and I work in the venture business. But because of John's portfolio, I have exposure to more general equity markets, right? Because that's part of what we do. It's not all of what we do. And what I've concluded is everything runs downhill, right? I think of the equity markets, overall stock market, not the Dow. I'll look at the NASDAQ. That's a little more applicable for smaller companies. But that has an impact, a much more of an impact, excuse me, than I ever thought on the venture markets. And I'll talk about that. Initial public offerings. I've got some interesting stats about IPOs. And you think, okay, not a lot of companies go public. How does that really affect us? You build companies to sell. True. In today's market, you build companies to sell to a buyer. You build a great company first, and the liquidity event will happen. I've got some interesting stats, compare it to years ago and how this market has been impacted. Because public companies, and this is a general statement, it's not always true, but public companies generally trade at higher multiples than private companies. Not always true, but generally that's still correct. So if you're looking to maximize value and you've got a great company, you don't want to sell out, going public, providing liquidity for shareholders, usually is a good result, if the company can handle the market. Of course, mergers and acquisitions, I will not provide much detail on that, and then I'll talk about venture capital. But what I've concluded is the top really affects the bottom much more than I ever would have guessed. This is 15 years of NASDAQ, and I've been with John about 15 years. A couple items here. Think about when I started. This is just the general NASDAQ, okay? NASDAQ composite. Right here is I think that's probably long-term capital management. Anyone remember long-term capital management? John Meriwether, big hedge fund that collapsed. You could just see these things. Then, of course, IPO market craze. This was the peak about March 8th, March 6th of 2000. We actually filed a company to go public March 30th of 2000. And to give you a sense of how much this impacted just us on one deal, that company we're going to raise $40 million. It was roughly a $125, $130 million valuation. Okay? We filed it March 31. Okay, so we're about 6 months too late. Wish we could have got it done sooner. March 31, that deal never got done. It was with UBS, William Blair, trying to think who the other banker was. That deal never got done. Not many deals got done in the second half of 2000 after the market crash. We ended up selling that company, and it was cash flow positive, doing well, but it was about break even and what we're going to do with it. We sold it within, the next year to 2 years for about, I think it was about $35 million. And that was a good deal. The market came down that hard. Public market access was shut off. Did we have to sell that? We had some debt maturing. We had a couple of issues. I wouldn't say that our back was against the wall, but if we would have waited another year, our back would have been against the wall. And the market had changed. So, okay, here, peak. Of course, that's 2000. And this area right here is what I call the nuclear winter for venture capital. Very interesting time. Very interesting time to be in venture. We said everyone had to feed their own flock. Every firm put money in their existing companies. Here's an entrepreneur I know that we put money in his company, and we kept feeding it to keep it alive because it was so difficult. There was such a crash, and not just in the public markets, but in the venture markets, that firms kind of seized up. They weren't investing in new deals. So if you got all these Silicon Valley firms, East Coast firms, not investing in new deals, and there's exceptions, of course, but mostly feeding their own flock, every other firm that had deals that needed capital had to put up or write off, right? Put it up or write it off. So right there, nuclear winter, not a very fun time. Things started getting better, of course. Then right about here is probably right about there is Bear Stearns. No, I'm sorry. Right about here is Bear Stearns, and then there's Lehman Brothers right there, September 15th. I was actually in New York. We had a company, and this is one of the benefits of being a healthcare investor. We had a company in 2009. It was the best performer on NASDAQ, or it was some period, maybe it was through June 30 of 2009. The best performer on NASDAQ. And I think it had a little more than doubled, which usually probably isn't top 20, right? I mean, usually there's companies, but think of that market in 2008. I mean, that was a tough sledding year. I mean, sorry, this is 2008. So I was in New York October 6th of 2008. In the NASDAQ, we were in the bell, closing bell, right? This is great. You go in there, and I'd never been in there before. You go in, and it's all these circular screens. It's a wall like this, of course, 50 feet high, circular screens. Each one's a TV monitor. It's Apple, Microsoft. It's all the big NASDAQ stocks. And they're green if they're up, and they're red if they're down. So we walk in, it's about 1/3 green, 2/3 red. That's 20 minutes before the bell. I turn around after the bell, Every single one was red. Every single one. The market was down 666. You know, it was one of those crazy times when it was down 240 when we went in there, and it would drop 400 points in the last 20 minutes. I mean, I don't know how many remember those days. Interesting times. And it was really interesting. It was fun to be there. I mean, it wasn't fun on the portfolio point of view, but it's fun to be there. We went to a restaurant to celebrate, you know, the performance. I think our stock was up, but we weren't big enough to be on one of those. Anyway, went to a restaurant right next to Lehman Brothers' office that was a ghost town. I mean, this company, I'm sure that restaurant went out of business, but it's too bad. Anyway, this right here is what I call, you know, and most people don't experience 2 nuclear events in their lifetime. We did in venture capital. That was another much shorter nuclear winter. This one was really extended. That was 2, 3, 4 years. This is more like a year and a half. But that was another tough sledding time. People were feeding their own flock. Not as much as the earlier one, but it was still a very tough time in the market. So, and of course, you know where we're at today. Anyone want to guess what 291 is? Number of phone calls. Is it the number of phone calls that CEOs call a week before they need money? It's pretty close to that, actually. Is it the number of write-offs we've had? I hope not. It is tech IPOs, in basically the last 10 years. Tech IPOs. Think of that. 2008, there were 3 technology companies that went public. This is not a lot of IPOs. This is disheartening from my point of view. I mean, 21 so far this year, that's good. But you know, look at that year, 1915. I mean, that was tough sledding. A lot of tough sledding years. This is overall going public. Overall companies, not just tech companies. Okay? This is a summary. If you look at this, I just parted it for the last 10 years. Look at the number of IPOs there. That 10-year period, 5,831 IPOs. These are U.S.-based IPOs. I think it's on all exchanges. Okay? Not just the NASDAQ, all exchanges. But look at all those. You know, 400, I mean, the low here was what, 370. The last 10 years, we haven't had one year that was higher than the low the 10 previous years. 1,358 IPOs in the last 10 years. Okay? 77%. Down, that's 10-year periods, down 77%. Now, it makes sense here. I mean, of course, 2000, I couldn't believe there was that many in 2000. That must have been, I bet that was 80% of them in the first quarter of 2000. I'm serious, I bet it was, because it was crazy there, and then it crashed, and it crashed hard, and nothing got done. Look at it, down 77%. Think, wow, that's a tough market. Then I looked at the venture stats. Okay, and this is a little different than our firm, because again, we invest our own capital. But most firms invest outside money, right? So they go out and raise limited partnerships, they raise funds. New VC fund commitments. So this could be existing funds. This could be Kleiner Perkins 7, right? Probably the most well-known firm. But in 2000, which admittedly was a peak, 635 funds, 106 billion of commitments, okay, to get that capital and to invest it. 2010, 12 billion in commitments, 157 funds. Actually, 12 billion was not the low. It was about 2003. I think it was only 9 billion. So think of that. From new fund commitments in 2000 to about 2003, went from 106 billion to 9 billion. So what's this tell you? That there's maybe a lot less capital available than there used to be in many ways. Okay, I mean, the public markets aren't near as open as they used to be. Venture funds, and again, this is just two years, but the overall trend, the 10 years before that, it was building up steep to the peak of 106 billion, and then it came down really quick and went through a couple gyrations to get where we're at in 2010. Down 89%. What's the summary? It's been a tough sledding year. I mean, I feel like Joe Frazier. You know, 10 years, we're taking it on the chin. What's amazing, and I hadn't even focused on this. I remember in early 2000, 2001, we said, hey, this is going to change things for a long time. I thought it'd come back by now. I wouldn't have guessed 10 years. Matter of fact, I found a presentation, I have it here, that I did in 2002, maybe it was early 2003. And it was overall market update. One of my issues was the IPO market's changed for the next number of years just because of this crash. Venture market, going to be a lot less capital available, a lot fewer funds available. Some of those things I was right on. I don't think I would have got the timing right. I wouldn't have guessed 10 years. Now there's been a lot of other things that have happened, but it's had an impact. What are the lessons from the last 15 years? there is hope, okay? There is hope. Number one, the environment has changed. That's pretty clear. I already covered that one. Entrepreneurs, this is the most exciting thing. Entrepreneurs have evolved. I mean, back in the late 90s, early 2000s, I saw so many plans that were pretty much startup companies that we need $3 to $5 million and we're going to do this, this, and this, and 2 years from now we're going to have a product. I mean, anyone remember those times? I mean, I almost laugh when I see that kind of plan now. I mean, there's some exceptions. I've seen some clean tech deals that have done a lot of work. They need to build a plant, you know, a smaller plant to prove it. You know, they need $5 to $10 million to build that smaller plant. I understand that because they've done a lot of work, but it's not a startup business plan. Here, raise $3 to $5 million. Hey, Roger. My neighbor, funny story. I was in Washington, D.C. I think I shocked you and your wife. I was in Washington, D.C. at a hotel. I look over, and I see Roger, and I go over and tap on his shoulder, and then his eyes about popped out of his head because here's the neighbor from the backyard showed up in Washington, D.C. at his hotel. Anyway, I'll get to that. That's road trip. That's my road trip section. Entrepreneurs have evolved, though. They figured out, and I think the entrepreneurs figured this out. Maybe they just got told no so much from the capital front because there wasn't any capital. But they figured out, you know what, we got to do a lot more with a lot less and get a lot further down the road so we can, you know, prove value and take less dilution, and we need less capital. That's exciting. It's very exciting. And then new sources have emerged. Progress with no capital. Entrepreneurs evolving. They make a lot more progress today than 10 years ago with very little capital. And, you know, I think of it, little business I was involved with, you know, Google Docs, the Google Maps. It was plotting locations. I just think of what 2 or 3 people did with these free online tools that 10 years ago I think people, I mean, maybe they could do it. I wasn't aware of it. Generally, people didn't do it. Launch and adjust strategy. You know, let's get a product. It's not going to be perfect. Let's get it in the market, get the feedback. That whole feedback loop has really changed in 10 years. Everyone see that? Everybody see? I mean, it's amazing how that's changed in the last 10 years and how much more refined it is becoming. Speed over control. Used to have very detailed discussion. Find a business that we like. Maybe there's some traction. They still need $2 or $3 million to take to the next level. I would say today's entrepreneurs are much more focused on, hey, we need to get there sooner. We can't spend 6 months horse trading over, you know, a couple equity points. You know, the question is, do I have the right partner in terms of an equity investor? And then if we do, let's hook up and let's move forward because we're losing time in the market. Right? That's much more pronounced. I hear that from entrepreneurs. I think entrepreneurs get that a lot more than maybe 10 years ago. And I think a lot of investors do also. Start something. Judy Isles up at Iowa State has a little tagline. She's with the Entrepreneurial Center up there. And it's, of course, directed more towards the students, but start something. You know, start a company. I see this more now. I think there's younger entrepreneurs that see success stories of people, you know, other entrepreneurs starting companies with very little capital, doing it on a shoestring, getting and building something of value, and then doing it all over again. You know, there's less of this, hey, it's my baby, and this is going to be my 20-year deal. We're not quick flip artists, right? We're not, hey, let's build it and spin it right away. You got to build a good company. But realize, and I think the entrepreneurs today realize that these markets don't last forever. If we build a lot of value that's interesting to a partner, maybe that's not going to be interesting to that partner 3 years from now. So hit the bid, strike while the iron's hot, whatever you want to call it. If start something, and you know what, if I sell a business, maybe I don't make as much on it as I thought I would, but I can start something else. That's definitely more pronounced now than it was 10 years ago. New capital sources. Capital efficiency as a #1 priority. I just see this a lot more now than we did 5 years ago or 10 years ago. You know, everyone has experienced dilution. You know, entrepreneurs have experienced dilution. If they went through maybe that 2000 time frame and got some of these what I call tough love term sheets that are, you know, multiple liquidation preference from the big VC, you know, that was very unpleasant. Very unpleasant. You end up building a company and you didn't get much out of it at the end of the day. It was a tough situation at the time, good experience for entrepreneurs that survived. But it's got everyone focused on capital efficiency. One thing about our firm, we're investing our own scratch, right? So we've always been here. We've always been focused on capital efficiency. We don't have the incentive to, hey, I want to invest $30 million over X number of years. because money we don't invest, we can do something else with. So we've always been on this one. Angels and startup funds, more active now than ever. Matter of fact, I know, is it Startup City Des Moines is starting? You know, that's new. That's, you know, Y Combinator, a lot of different models are out there that are working, and angels are getting more active, I would say, to help make up for fewer venture funds, maybe less overall capital in the marketplace. But, you know, still combined with entrepreneurs getting more creative and doing it with less capital, it's a good combination. Federal and state sources. We have a clean tech investment that we invested some capital in. We're able to get a $2.5 million grant from the state, and now I don't have all the paperwork done, but it looks like a $2.5 million grant from the feds. So that's $5 million towards basically a $7 or $8 million capital need that, you know, I mean, I think I'm a supporter. Everyone likes lower taxes, but I'm a supporter of some of this renewable energy investment in the right area. We're just talking about how the oil lobby, you know, just succeeded in retaining their, what, $2 or $3 billion annual subsidy, which I don't get. You know, they're making more money than ever, but hey, I support the federal and state subsidies to some of these companies, you know, after a full tech review. But that's, you know, it's just leverage, right? Different source, getting creative on finding sources of money. The PIPE market. PIPE market, that stands for private investment in a public equity. So if you're a public company, this is a market that's open. It's not open to private companies, but that's a very active market. There are a whole group of investors that invest, you know, $5 to $100 million in these public companies, and it's not necessarily a public offering. If you need capital, we've talked about this. I think I beat this one to death. Capital efficiency to preserve equity value. Raise it when it's available. Too often people wait until there's no gas in the tank. You know, I need money in 3 months. 3 months is too late. You know, you might be able to get money. It's going to cost an arm and a leg. But be smart about this. I always tell, I mean, we focus on our companies. You really have to have a lot of runway. And you have to have, I mean, the best thing is to reach cash flow positive. That's the best thing, the best route, right? Because then you don't have to take it. That's absolutely should be the focus of every company, is not just reach cash flow positive or minimize the burn. You know, there's a balance there. You're trying to build the company, but every now and then see an interesting company and their burn is something like $1 million a month, and they're trying to raise $5 million. Why? So they can last 5 months? I mean, are you kidding me? I just can't believe they can even go for that kind of pitch. I've heard that, I mean, a lot of times. I see that often. This is one thing that I think has changed, just this whole capital efficiency. Companies have realized, hey, we can't be burning $500,000 a year unless we have $10 million in the bank. And then it doesn't make sense to burn $500,000 a year. 6 to 12 months, 6 months is really tight. If you only have 6 months capital left, I think, you know, it's tough. You know, and this assumes you have a financeable business, you know, exciting business to your prospects. But it's, you gotta start early. Cast a wide net. I see this all the time where entrepreneurs and companies will go and they'll start dancing with a partner and they think, hey, we found a good partner. I just don't believe in that. I think you've got to talk to a lot of people, because I've just seen so many of those, you know, fall out of bed. Now, hey, if you can get it done in 2 weeks, great. And you got a year of cash left. You know, I believe in pushing hard and fast. You know, if you've got a deal, try to get it done. But I see all the time where entrepreneurs talk to one investor, learn a little something, then talk to another investor. You've got to talk to a lot of them at once. You really have to. Plan the introductions. This is so key. You know, this market is smaller than it used to be, this venture market. And the angel market. I mean, angel market I think is actually growing. But you have to be really strategic about, hey, what's the best way, what's the best route to get in front of some of these investors? We have a CEO this week. He's in Canada pitching some investors with a deal up there that has some applicability to their market. And we spent a lot of time, you know, planning this trip in advance. How do we get in front of the right people up there? And I think we did a great job of that. But it wasn't easy. You know, you got to do a lot of research, understand what these investors have in their portfolio. What do they have an interest in? What do they not have an interest in? We were just pitched on a deal. It was in a sector that we had a pretty big loser in. You know, I mean, we looked at it. You know, interesting. I know a lot about the business, but it's just tough to shake off that bad history. Maybe the whole market's going to turn around, and hopefully we'll be smart enough to see that. But, you know, I hope we weren't their first call. Plan the introductions. This has hit the road. And this is one of my criticisms generally of Iowa companies. You know, I hear complaints once in a while about investors here in the area. Hey, get on the road. Green money. You know, you got to go wherever the money's at. We spend most of our time raising money outside the state. We hardly ever raise money for our companies in the state. And it's tough. You know, it takes a lot of time, but get it together, get your pitch together, and then go out there and do it. This is another mistake, and this is entrepreneurs all over, not just here in Iowa. I can't believe how bad they are at follow-up, generally. You know, it's shocking to me. Investors, I get all kinds of plans or interesting deals. I take a look at it. You know, if I have really strong interest, I'll follow up right away. But, you know, we're looking at a lot of deals. You know, it's tough to get them up on the radar screen, right? Investors take calls. They will follow up if someone's persistent trying to reach them. They'll look at it. They'll spend time on it. And hopefully they will anyway, right? But I can't believe how often I get a plan or something, you know, it gets stuck in a pile, it's not a priority, and I never hear from that investor again. I've never responded, and I never hear. That happens to me all the time. Hopefully I usually respond. But I run across this once in a while. I just think it's very unusual. Why'd they take the time to send it if they're not ever going to follow up? I see it often. And you notice the plane ticket there. That's a big part of it. The market's not dead. I think there's more opportunity now than ever. It's changed a lot. You know, people need to recognize it's changed a lot. It's a different market than it was 10 years ago. And that's my perspective. I think of it over the whole term I've been in this business. The basics, you know, these haven't changed. Well, the last one's changed. These are the things I think, you know, investors need to have ready, right? They need to have their pitch down, their investor deck, summary, just have the different components, because when I call an investor, if I get an interest level, you know, they're going to say, send me an executive summary, or send me your deck and let's set up a call. You got to have them all ready. If someone calls me and I say, hey, send me a 2-page summary, and I don't hear from them for 3 weeks, you know, that's ancient history. I don't want to say I don't remember the deal. Hopefully I do remember the deal. But you need to have it ready and strike while the iron's hot. Evidence. This is one that's changed in 10 years. This is back to the, you know, it used to be $3 million and we'll have it built in 2 years. Everyone now is focused on what have you really done to develop a product? How have you tested it? Show me the results of that. You know, I love the Clark McLeod story. I heard it one time where he, and I don't remember if it was Teleconnect or McLeod USA, I think it was Teleconnect, literally put together marketing materials. I'm sure they're rough, but went out and pitched like 20 companies. He did it personally, or he and one other person did this. This is probably when he's still a school teacher, right? Wasn't he a school teacher and then started Teleconnect? Went out and pitched 20 companies. Something like 17 or 18 said, if you offered that, we'd switch. Okay? Great evidence. Great evidence that you're onto something. I don't see that near often enough. You know, that's just one item. Any evidence would be great. Get the feedback. You know, it's a circle, right? It's a cycle. These are pretty basic. I'm really shocked at how often entrepreneurs don't know their competition, which can be pretty embarrassing, not necessarily me, but I've been in pitches before to other investors with our company, and the other investor asked about a couple companies, and they weren't on our radar screen. It's embarrassing, right? You want to know the marketplace. You want to show your knowledge. Constant refinement. I mean, I don't know how many copies of some of these pitch decks, too many on the hard drive, right? I mean, there's little changes. You save it as a new one. Or you're getting rid of the old ones, hopefully. Research your targets. I'm talking about investment targets here. We talked about understanding what's in their portfolio. Researching the targets takes a lot of time. You know, anyone that's an entrepreneur knows, anyone in here that's an entrepreneur knows, this is not a 9-to-5 deal. This is what you do late at night, right? This is the little details that make a difference. Understanding that they have XYZ company in their portfolio, so maybe that starts the conversation when you meet them. And that could be the difference. Engage others to help. You know, I mean, I've called Chris Sackett to talk to him about a company, and does he have any ideas for investors? I do that all the time. One lead, even if we meet with an investment group and they turn us down in the meeting, you know, I absolutely will ask them, do they have any other ideas? You know, sometimes if they really don't like it, they say no, just leave. But usually people are pretty nice, and they say, well, you know, XYZ may have an interest in that field. You know, these connections are important. Building the business, the challenges of building the business, you know, assuming capital and this is not, that's what it's all about right there, right? The overall message, great companies can always raise capital. Even in the worst markets. Matter of fact, didn't Principal go public like right after 9/11? I think it was the first company to go public after 9/11. Okay? And they, due to their structure, wouldn't have had a price sensitivity, maybe some others. The question is price. Great companies can always raise money. Let me X out the month of October and October of 08 and March of 09. Those were tough months. I don't know if anyone would raise money in those months. But great companies can always raise money. It's a question of price. So focus on building a great company. Keys to success. I always say the most critical factor, and anyone that's heard me has heard this before, it's people and motivation. The people are the key, but understanding their motivation. And this is not just your top executives. It's your partners, whether they're venture firms or other angel investors. Understand what the motivation is. Understand their background. Like our firm, as an example, is different than many other venture firms. We invest our own capital. So we don't have this desire. I mean, if you understand how typical venture firms, limited partner venture firms work, they're incentivized to put more capital to work, which is great. Maybe you want $20 million, and that's what you need. Then it's a great fit. But there's also an incentive. I mean, they need to put more money to work so they can be successful. They get paid to put money to work, right? Invest their fund, and then go out and raise another fund. So it's just a different, we're focused on capital efficiency because we want to build equity value. So we believe our alignment of interest with like a common stock founder is better, right? Because generally we want to invest, and if we never need capital again, that is fantastic. We love that. We love those kind of deals. Those are our best returners. Ones that, I think of a deal we did 63 times our money, and I think of a deal at John, he did 250 times his money. What were the key in those deals? New market, became a market leader, invested early on a capital efficient model, and grew a company from almost no revenue or $3 million in revenue to $300 million in revenue. Those are the big winners for us. That's our model, right? Which the common stock founders in those deals did very, very well. Now, if you're Facebook, you do very, very well, right? I'm not, even though they took a lot of capital, but understand the motivation, and the background of your partners on the capital side and really throughout your whole company. Building the team. As a team, are they equity or paycheck focused? Too often, and there's, a company as it grows, they're not all going to be equity focused. Matter of fact, I started, and John still is in this position of every employee has equity. I think I've moved off that some, because some employees, in my opinion, just don't appreciate it, don't give it any value. So I'm like, why waste the equity? I'm tight with the equity that way. But are your top people focused? For us as an investor, we're focused on building equity. So we want our top people running these companies focused on building equity value. So we basically all get paid the same, right? Talent and drive. Do they have the drive really needed to build these small companies? Same for the partners. Alignment of interest. One funny story. And this is serious. We were making a pitch to a hedge fund. And no, I'm sorry, maybe it was a mutual fund. I think it was a hedge fund. But we're talking about holding period, investing in this company. And they said, well, we're long-term investors. We hold everything for at least 6 months. And they were serious. They were serious. And I'm like, wow, what a different world. But, I think of a deal. We actually have a deal, and a big firm, big New York firm invested. They invested $5 million, and it was with a firm that's not actually now gone out of business. But we're doing a private deal, and they basically said, hey, we like this company, we want to invest, but our pool to invest in private-only companies is about this big. If you merge it with the public company, our pool is about this big. Merge it with the public company, and we're in. And we did. We dealt with a lot of public companies that that's something we can deal with. And our CEO, this is that CEO that has ran 3 public companies. But that, understanding the investor, understanding what their motivation is and their needs, for them it was just fixing the problem of we don't have enough capital in this pool of private only. So they really want to invest. They've been a great long-term investor. Their company's defunct, and it's actually in a separate fund now. But they've been in that deal, I think, like 7 years, 6 years. Does a partner have an ability to have a positive impact? I think of sports, an impact on winning, right? That's what we're after. Different directors we add to a company. that come on. Can they have an impact on winning? It's very key. Otherwise, I don't want to say it's wasted space. You know, public companies, you got to have, you know, all the financial directors, you got to have all this. But we're focused, we'd much rather have 5 directors that are all seriously engaged than a board of 9 with a bunch of big names on it. That's how we operate, and that's how we think of partners. We think of directors of companies as partners. You know, they're going to get an equity stake in the company, and are they going to be engaged and have an impact? The conclusion. Focus on building a great company. Great companies get financing. It's a question of price. Course corrections. You know, even our deals, you know, that did 250 times our money or 63 times our money, there are a lot of course corrections. You know, nothing goes straight up. And I look at those, I look at the history of those 2 projects, tremendously successful, and there were times in those companies we wondered what we're doing. I mean, oh my gosh, is this thing going to work? And we made changes, and they did very well. You know, if you're raising capital in this market, prepare to knock on a lot of doors. You know, we say, kiss a lot of frogs, right? Hopefully you meet your prince the first meeting. Not our experience, but you know, you gotta plan to knock on a lot of doors. Control your own destiny. We say happiness is positive cash flow, okay, in our business. Because then either we control our own destiny, we don't need to take any more dilution. You know, that's what we're focused on, getting our company's positive cash flow. Okay, thanks for the time.